Hello traders, this is Blake Morrow and you are listening to the week ahead video for the 4th of July weekend, and it's actually the 4th of July today, the day of recording, although this is the video for July the 5th. I'm filming it today because we're on lockdown and I mean, I want to celebrate 4th of July and we are gonna have a barbecue, just our family since we're in lockdown. That means my wife and 2 kids. But other than that, the days kind of blend in together where I live. So anyway, happy 4th of July for those of you that are in the United States celebrating our independence. For those of you outside of the United States and the rest of the world, I hope you're enjoying a little extended weekend. I know Friday was really slow as that was our observed holiday. Anyway, before I get into the charts, and before I get into what's going on this next week, I have to mention to you, if you haven't tried out ForexAnalytix, make sure you do so. It's only $1 for 10 days. All right, it's very easy to try out. And it doesn't matter whether you're using the premium version of ForexAnalytix or the light version. You're going to get to test the premium version for $1. All right, so that also means download the mobile app from the App Store or the Google Play Store while you're testing it out, because even if you use the light version, you're still going to be able to use the app. Okay, because you're going to get all your analysis, on your mobile devices if you're not logged in at the desktop, and that'll allow you access to the chat room for the next 10 days and whatnot. So make sure you try it out, and I appreciate those of you that support ForexAnalytix right now and continue to support our company. So let's talk about what things I'm going to make actually this week pretty easy. Let me get rid of this data flash. This is a part of the desktop application that when news is released, this comes out about as quick as Bloomberg. Not quite as fast, but pretty darn fast. It's nice to have, to get your news releases. Okay, let's talk about what's happening this next week. And like I said, I'm going to make this week's video pretty simple. Not necessarily short, I'm just going to make it really simple. All right. Next week we have the ISM data, that the services data, but it doesn't really matter. Well, it does actually matter. I should take that back, because the market is looking for us to get back to 50, which is the 50 is the expansion contraction bull bear line, if you will, for services data, but we're expected to get back to 50, so above or below might actually move the market on Monday. And then Monday night or Tuesday morning in Australia, we do have the RBA rate decision. The RBA is expected to keep rates unchanged, and we're going to talk about the Aussie here in a moment, but that's going to be an important potential pivot in the market. But I'll show you the charts here in just a moment. Also, at the end of the week, we have Canadian jobs report. The jobs report was for the U.S. on Friday, which was not really a market mover. Yes, I'm sorry, I meant on Thursday because we had Friday as an observed holiday, but it still did move the market. So let's talk about this last week, and let's talk about where we're at, because I'm going to start off. Oh, actually, I got to go over one other thing when using ForexAnalytix. You'll notice right over here, we have on the right hand side, you'll see the news feed. It's powered by LiveSquawk, right? Live stream. We have, you can see just over the last few hours, some basic technical analysis and candlestick charts have been updated by Steve is doing those right now, and I typically do those during the week, but during the weekend, Steve and the rest of the team will update some of the charts, and right now they're getting updated. So not all of them are going to be updated, but you can see over here where it says last updated, we do have here's the euro dollar. Let's go over to the daily chart here in the euro, and you can see that was updated. And actually I can actually start here, but I am going to be drawing on my own charts because I want to show you some specific things. And I'm going to go back to the S&P here in a second, but I'm going to talk about the euro because the euro is important because you can see this really tight consolidation, and frankly, we get above 113, it's very bullish. You're going to get this bull flag pattern that's developing. The thing I worry most about technically about the euro right now, as far as the flag pattern goes, is that this flag pattern, it's once the flag itself is more than 50% of the flag stick, it's not really a flag. Now it's just more of a descending channel. However, and what that usually means that, my projections for a flag would be, flag pole, taking us up somewhere up there. Usually I would say, okay, well, now this is just more of a breakout, and we'll just have to, just think of it as, kind of range bound, But what's most important about this chart is actually if you go back to the euro and actually, let's do it this way. You look at the daily chart here. This downtrend line, this started in February 2018. That's capped us. So, and this is going back to where I was drawing. So, typically this is starting to get long in the tooth. But if we break out, I expect it to be pretty severe. I expect the breakout to really take hold and us to trade up towards 116, 117. It's not a given though. The euro has really floundered around, and surprisingly it hasn't moved higher as equities have moved higher. So that's where I have to start. I really wanted to start. I want to start where equities are at. So you have the S&P. The S&P broke this triangle. We're above the 200-day moving average. Frankly, if we break above this resistance at 31.65, we should challenge these highs and quite possibly challenge all-time highs. I know it's tough for all of us to comprehend the idea that, oh man, the economy, I mean, you lost what, 20 some odd million jobs. Yeah, we've gained, 6, 7 back or whatever the number is, and we're probably going to gain more back, but net we're still down 10 million jobs, 12 million, 15 million, whatever number you guys want to argue with me is going looking out a month or two or whatever. How is that even possible that the stock market's at all-time highs with some jobs probably not even going to come back? We have a sputtering reopening with the economy because of COVID. Let's dismiss that for a second and realize that the stock market is not the economy at this point, and it hasn't been for a while. And the reason why is because of the massive Fed intervention. So when you have this massive liquidity behind the stock market, everybody is chasing yield. The path of least resistance for equities is higher. Is that going to be the case forever? No. And excuse me. I'm sorry. That's just more me. I'm not coughing normally. Just letting you know that. I know I'm in Arizona, and a lot of you guys know, and you guys are a little worried about where I'm at. But look, I don't really go anywhere. We could, push to new highs and reverse. We could continue it to new highs. I mean, I just think we're going higher for now. So let's just understand that while we're above the 200-day moving average, I do not believe there's any reason to be bearish in the equity markets. There's a lot of reasons to be bearish. Technically, there's no reason to be bearish. There are a lot of fundamental reasons where you look at the market and say, why are we even going higher? I mean, I know we're going to start going into earnings season, and that might influence the stock market a little bit, but right now everybody's chasing yield, guys. Everybody, all right? And it's not just the S&P breaking out; it's the NASDAQ too. And I know this is my my chart of the day from the other day. I think it was on Thursday. And this is pretty simple. While we're above here, you're bullish. While you're above this breakout point here, not that one, this breakout point here, you have to remain bullish, but a little concerned with the rally, and only back below, what is that, 90? Let's just say 9,800 in the NASDAQ 100. That's when you start to get a little concerned and actually turn bearish. So right here, where we're at, it's bullish. NASDAQ's breaking out. S&P is trying to break out. The Dow hasn't broken out yet, but that doesn't mean it can't, because once the Dow gets above the 200-day moving average, if it does, okay, then you got the Dow moving higher, the S&P moving higher, the NASDAQ moving higher, everything's moving higher, right? Now, in currencies, we can almost confirm that, because in currencies for right now, the correlation of stronger stocks, weaker dollar is valid, right? So let's go to the euro. We'll start there. The euro, as long as the stock market continues to break out, maybe it's, once you get the Dow, the NASDAQ, and the S&P breaking out, maybe that's the catalyst that can drive the euro past this resistance. Maybe it's the ISM number, maybe it's, but I mean, I'm looking for an upside break. You get below 111.50, and that's where things start to get a little shaky for euro longs. But right now, there's no reason to be bearish. There's none, right? And you can argue that we're consolidating in a triangle here, right? And looking to break higher, right? Okay. Cable, the cable guy. We're 50% retracement. We get above that. Next thing you know, we should be challenging the 200-day moving average and maybe this downtrend line, and then we turn bullish, above here. All right. So the cable really could turn bullish, above 127 roughly, right? Let's talk about the Aussie. So we have the Australian, the RBA, actually on Monday night. It's actually Tuesday morning if you live in Australia or in Asia, but for those of us in North America, it's going to be Monday night. The Aussie is breaking out, and as long as the Aussie remains above 69 cents, there's no reason to be bearish. And this, I mean, you look at like from a weekly standpoint, look at this. That in all actuality, this is from 2008, the financial crisis, right? That was a false breakdown. That's bullish. It is bullish, right? So, I mean, the Aussie should continue to break higher. Kiwi, multi-year trend line. We're knocking our head up against it here. This trend line goes from I almost said 1914, 2014. Never mind. I was going to say something funny, but I'm not going to. All right, so there's the 2014, and you guys want to know what it is, don't you? But I'm not going to go there. All right, so here's the dollar Canadian. Now, the dollar Canadian. Let's talk about this for a second. And the dollar Canadian is trying to break down after failing at 137 this last week. This is a descending channel. The 200-day moving average is coming right into play. Listen, the dollar Canadian actually is holding up really well. If there's a reason that stocks start coming down, which again, there's a multitude of reasons why they would, but technically they're not doing it. But let's say the market shifts, sentiment shifts somehow. Why, I have no idea. Who knows? President Trump gets the coronavirus and he's in the hospital. Who knows? If something like that happens, guess what stocks are going to do? They're going to go down. And guess what the dollar is going to do? It's going to go higher, right? Is it unlikely? Probably unlikely, but could things happen? Sure, things can shift, and they can happen quickly. So if that happens, I'll tell you, the one currency that I really think is bullish as far as the US dollar goes is the dollar Canadian, because it is holding up really well. However, if things continue on the path that we're on, the dollar Canadian should drop back to this 133 level. All right, and it's been holding up really well. But we do have the Canadian jobs report on Friday, right? And if the Canadian jobs report is a lot stronger, I mean, the market's looking for to create about 550,000 jobs in Canada. Well, let's say they create more than that. I mean, heck, we could see the dollar Canadian drop, as long as stocks continue to stay strong. So that's another, that's a currency pair that I think we need to watch going into this next week, because in the event the dollar Canadian breaks this downtrend line, I will turn insta bullish, right? But until then, you have to focus on the downside, because that's what the dollar is doing across the board. Probably last currency pair I'm going to talk about is the dollar Mexican peso. This was my chart of the day on Wednesday. Broke out of this ascending wedge, failed at the 38% retracement. And if you think about this from an AB equals CD standpoint, it should do this. This would be A right here. A, B, C, D, C, D. Right? We should drop back below 20, realistically, if the dollar continues to weaken and stocks continue to stay strong. So the what I'm trying to point out here is, as long as the stock market stays strong and we continue to break higher in equities, which again, I know all the reasons why it shouldn't go higher, but technically it looks like it's going higher, and I wouldn't be surprised if we trade into new highs, not necessarily this week, but look, the stock market has defied gravity, and you kind of gotta realize that unless we get back below the 200-day moving average, it's bullish. And I've been hoping that we would correct through the summer and give us a little bit more downside, but the market just doesn't care. It doesn't care, and you have to go with what we're seeing, versus how you may feel about the market. And right now, as long as we're above these levels and above the 200-day moving average, no reason to be bearish. So if the stock market is going to stay strong and going higher and climbing that wall of worry, then we have to assume that with the massive liquidity that the Fed is providing to the market, that the dollar is going to continue to stay weak. Okay, and I'll be the first to admit that, hey, I thought the stock market would have been rolling over by now, but it's not. So if it's not, you have to trade accordingly. And in this case, you have to continue to look for the dollar to weaken. So like I said, I was going to make today's webinar relatively simple, not necessarily short, but simple. All right. And until we start to see some changes in equities, because it's almost like it's one trade. Oh, you know what? There is something else I need to talk about before I let you go for the weekend, and to enjoy the remainder of your weekend. Let's talk about gold really quick. This is one of those too that if you go back to the if you listen on the F.A.C.E webinar daily, then you've heard me say this already, but let's talk about it again. Let's look past the let's go back to the financial crisis, right? The great financial crisis, which was 2007, 2008. Remember, the Fed added all that liquidity. What did the stock market do? The stock market went higher. What did gold do? Look, let's compare this to, let's overlay it to the SPX 500. Okay. Stocks went higher, right? Because of all the liquidity that the market provided. And what did gold do? It went higher as well. Why? Because the market got concerned about inflation and massive amounts of liquidity, and going into the asset that would be the best to shield you from any type of flare up in inflation and all these inflation fears. Even though I don't think that inflation is going to be an issue right now, I think it's deflation then inflation, but that's neither here nor there. What I'm trying to point out is, hey, if stocks continue to go higher, I think that that gold's going to continue to break out. And then if you go technically, let me hide that. Then you go technically with gold, we're not backing off. Gold is not breaking down. Gold is nearing those highs. And you could argue and say, well, Blake, relative strength is not confirming Relative strength is not confirming that we're going higher. You're right. Relative strength has actually worked off all the overbought conditions, and now we're back to levels where relative strength could, break out like you see it here, and we could go and challenge these overbought conditions back up in the 80s. Where would that put price if relative strength rallied to 80 or above? Well, that would probably put gold at all-time highs. So while we're trading above, let's just call it about 1700, 1750, 1740 in gold. There is no reason to be bearish. And silver too. Silver looks like it's on the cusp of breaking out. When I say breakout, it's a major breakout too, because you go back to a weekly chart. Excuse me. You go back to a weekly chart, and let me delete this really quick. I'm trying to delete this. You break through this descending channel here. You break above 19, 20 bucks. I mean, silver could be trading back in the 30s again. And think about what it did back during the GFC, the Great Financial Crisis. Look at what happened after the fact. To me, it looks like the exact same setup. So I think you guys should keep an eye on precious metals as well. So, guys, if you think that this video will be beneficial to you going into this next week and you liked it, give us a thumbs up if you're watching us on YouTube, because all of our the guys and gals that work behind the scenes, they love to see that, hey, you like the video, you like that we produce these videos for you, they're free, and it motivates myself and the rest of the team to continue to offer this analysis to you as we've been doing for years. So make sure you give us a thumbs up, subscribe to our channel so you don't miss any of the great interviews that Dale Pinkert does. And by the way, Dale is coming back on Monday. He had been out for a couple of days. So with that being said, my dogs are starting to bark. You might not be able to hear them, but if you can, I apologize. You guys have a great one. Thank you very much for your support. My name is Blake Morrow. Happy 4th of July. Hope you had a wonderful weekend for those of you celebrating the holiday. And I will see you on Monday morning. Thank you very much.